Hi, I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. I'm here with another edition of our monthly market update. Let's jump right in. Okay, August 2023, a lot has happened in the market since I was with you last. Let's get into this. Here's our talking points. All right, so welcome to the new bull market. The bear is gone, and stocks and bonds look to have bottomed last October, nearly a year ago. And in hindsight, it was really tough to see that. But we'll talk about some of the reasons why that happened. At the moment, year to date, the Dow is up about 8%. It's a pretty good year so far. And the S&P 500 is up 18%. There's a huge disparity there, and I'll talk to that in just a moment. Interest rates, we'll go over that. Fed policy rate now, their short-term interest rate is 5.5%, and that's higher than it's been since the early 80s, I believe sometime in 1981. And we don't believe that'll move much higher. Inflation looks to be moderating nicely, and it feels good to be able to say that. Finally, the economy looks okay. Core economic strength is probably okay, sufficient to avoid a costly recession, although there are some pockets of the economy that are suffering. I'll talk a little bit about those. And as always, we'll reassess our economy's likely landing as the Fed winds its rate tightening cycle down and as inflation falls back to something approaching normal. Okay, let's talk about the new bull market. So you can see the numbers here following a 34% bear market correction due to COVID. The market, or the S&P 500, rallied 100%. We saw a 27% correction, and now we're up 26 from the bottom. So because we're up more than 20%, technically this is a new bull market, even though to most people it doesn't really feel like it yet. But that is the fact. Now, it's a huge gain, right? And year to date, the S&P 500 is up like 18%. But I told you I'd mention that there's a big disparity between that and the Dow. And that's because most of the performance of the S&P 500 has been driven by just a handful of stocks, like Apple, Amazon, Meta, Google, Netflix. These companies, Microsoft is one too. So the top 5 really are responsible for over half of the S&P 500's return. So if I tell you the Dow is up, what was it, 8, and the S&P 500 is up 18, you know, cut that in half to get something more normal. And in fact, there is an index called the S&P 500 equal weighted that just weights all 500 companies equally in the index, and that's up about 8.5, something like that %. So why is that important? First of all, the S&P 500 has gotten far too concentrated in just a few stocks. I think Apple is now 8% of that index, and that is not necessarily all that healthy. You know, a lot of investment managers like to manage risk, and that means avoiding having just a couple of stocks take over your portfolio. So there's an issue with the index in terms of it being sort of a little bit misleading if you are invested in a broad swath of the US stock market. The other issue is that on the downside, if we do lose some of the support from Microsoft and Apple and Amazon, these stocks that have run a lot, either the rally is going to run out or we're going to have to find new leadership. Okay, so it looks like we have emerging signs that this market rally is broadening out, and like I said, it needs to, or we're going to lose it. On to bonds, it looks like the worst may be over for bonds as well, although hasn't been as great a year as rates. It's all about interest rates. As rates find their level, and the Fed continued to increase their short-term policy interest rate this year, and that really does cause, you know, bonds already issued at lower rates to become less attractive. So I just want to, just in very simple terms, address this chart like this. Bonds got far too expensive, especially as COVID came and everyone wanted in safe haven assets. I mean, interest rates were close to zero. And I remember fielding a lot of questions from clients about the value of the bond market. Why would we invest if interest rates are so low? Well, clearly a reset was needed, and you see it in this slide. 21% bear market correction for the disaggregate bond fund, which is just a mishmash of all different kinds of bonds in the U.S. That's a big move. And so the bond market's still trying to find its footing, but the bottom line is most fixed income investments have much better yields than they did before, so they're more attractively valued. That's why I say the worst is probably over. Okay, whip inflation now. That was the catchphrase in the 70s, early 80s when inflation spiked. I want to show you, though, more recently here, since COVID, what's happened to wholesale and retail inflation. Producer price index is the blue, and that's wholesale inflation. Those are costs incurred by businesses just in the course of trying to make a product or offer a service. And you'll notice at the end of that chart, we're looking at negative 3.1%. That means there's no longer inflation. We're seeing deflation in producer prices. So that can be good news for companies, because what that means is the cost of business is falling. Outside labor, of course, you know, wage growth is still 4.5%, but in terms of raw materials and things like that, we're looking at deflation. Now, the black line is the consumer price index, and that's, of course, retail inflation. That peaked out at over 9% last summer, and now we're looking at 3%. So we're closing in on the Fed's 2% target. This really does look like victory so far. And of course, everyone in the investment world is fretted about it. What if investment is sticky? What if it really doesn't go down? What if it never makes that 2% target? What if we're stuck at 2.5%, 3% forever? I think we sort of, in the investment world, we got ahead of ourselves and needed to wait a little bit of time. And sure enough, it looks like inflation is coming down. Now, our economy has suffered, and our financial markets have suffered a number of shocks. And I really had to sit and think about this. You forget, you get caught up in what's happening right now, and you forget all of the things that we've been through in a very short period of time. Since the end of the last bull market, which in my mind was the very beginning of 2022, we've suffered these shocks. February 2022, Russia invaded Ukraine. You remember the huge concern there for Americans was that we were seeing a massive spike in commodity prices, fear of global famine, energy shortages, natural gas, crude oil, and wheat, for instance, were up anywhere from 60% to 120% in no time. And remember, a barrel of oil spiked above $120 a barrel. It was a nightmare. I can say now that we are in all three of those commodities. We're lower than we were when before that war was initiated by Russia. So all of those fears, for long-term famine and energy spikes, those were unfounded, it turns out. June 2022, the CPI, or retail price inflation, hit 9%, 9.1 versus the prior year. That was the highest since 1981. And the Fed had been hiking for a few months, and really that was a bad number. And we thought at the time, wow, how are we going to, we know we're going to make progress getting this down, but how are we going to get it down before the Fed raises interest rates enough to collapse the economy? Remember, that was the race. It was a race between inflation and rate hikes. Looking back, it does look like we're on solid ground, and we are winning that race. November 2022, you might remember this massive collapse of a prominent crypto investment fund, clearinghouse slash brokerage, and that sparked panic in crypto markets. And it really revealed that a number of these companies, their balance sheets were a farce, and they were insolvent. I can say today, though, that if you look at Coinbase stock, it's higher now than it was then. So it's not just the US stock market that's higher than it was back in October. March 2023, of course, that marked the 1-year anniversary of the beginning of the Fed rate hike cycle. And by that time, they had already raised interest rates by about 500 basis points. And in 12 months, that's a pretty steep curve. We hadn't seen them take rates that high in such a short period of time since the early 80s. And that caused, the rapidity of that, sort of in the magnitude of that, caused this knock-on effect that ended up tanking Silicon Valley Bank and the other two S's. There were 3 S banks that failed in the wake of that crisis, and we saw bank stocks all across the piece, even with the majors, fall precipitously. So that mini bank crisis had the ability, could have taken down the financial system as it did back in the great financial crisis in 08. The Fed stepped in and offered emergency liquidity, and that issue today seems to be fairly well compartmentalized in some of these sort of idiosyncratic banks. June 2023, of course, we had to endure yet another debt ceiling crisis that wasn't resolved until the last minute and left investors worrying. How is the U.S. government going to find the funds to continue operating? We go through this every once in a while, and it's always hair-raising. And finally, just in the last few days, credit rating agency Fitch downgraded U.S. Treasury debt to AA+ from AAA, and this is the second time this has happened. Back in 2011, S&P, another prominent credit rating agency, also downgraded U.S. Treasury debt for the same reasons, really. Just an unwillingness to deal with the debt ceiling, an unwillingness to even attempt to cut spending or raise revenue, or both. I noticed that this time the market reaction was fairly muted compared with 2011. But nonetheless, this is a shock to the system, and all of these we managed to survive. Any one of these could really have sparked something broader in the economy. And so it's easy when you look at this list, it's easy to see why so many Wall Street analysts and economists were or have been bearish about our chances of avoiding a recession, or which they felt was really low. Other pieces of the economy, though, really have not signaled recession either. And I just want to go over a couple of them here. There has been a palpable fear that consumers would stop spending, that consumers, their household debt would rise too much, they start defaulting on their credit cards, they'd quit spending money, and this economy is driven by consumer spending. So let's take a look at this chart. And the green line is household debt as a percent of personal income. And you can see that it topped out back in 2008-9 at the end of the housing crash. And the number there is 115%. So household debt is more than 100% at that time than personal income. Okay, so a year's worth of personal income. So that's pretty significant, but it's come down steadily since then. And while there has been a rise in that uptick in that green line at the end of the chart, we're only back to pre-COVID levels. And so this does not signal recession to me. It does not signal that that consumers are facing their own financial cliff. The blue line, by the way, is just the delinquency rate on bank-issued credit cards, and we're not even up to 2019 levels yet. So something to watch, but really nothing serious here. U.S. business activity. I like this chart because it divides the economy into manufacturing and services. And services, we know, is a much bigger piece of our economy. What is it, 80% or more, versus manufacturing at 10 to 20. anything below 50 on this line means that business is contracting. So it's pretty clear the blue line, or manufacturing, has suffered recessionary conditions for months now. We might have seen the bottom. A number of indices recently indicate that sort of maybe we've seen the worst and we're going to improve from here. But it is true that the manufacturing piece and any company involved in commodities, they're really having a hard time right now. As opposed to that, though, the biggest chunk of the economy, services or non-manufacturing, is doing okay. And there's clearly been a slowdown, and that slowdown, interestingly enough, if you look at that orange line, it corresponds almost exactly with the Fed rate hike cycle. And I mean, you know, businesses have had a hard time of it coming out of recession, out of COVID recession. You know, you see spiking inflation, and so the cost of doing business rising, and then the Fed steps in, starts hiking interest rates, and now the cost of debt starts rising, and so it's you know, profit margins across the piece have fallen, no doubt. But it looks like business activity in the service sector is holding up okay. It's one of the big reasons why we haven't seen recession yet. All right, we got to talk about corporate earnings, because you know, the stock market really tends to follow earnings much more closely than it does the economy, and that makes sense, because if you're invested in the stock market, what you really care about is the potential sales growth and profit growth of the companies, the stocks that you're investing in. So this chart shows that relationship. The blue is the stock market, it's the S&P 500, and the orange is corporate earnings. And so they sort of follow each other. And this chart goes back to 2018, and it dips there in 2020 with COVID. You see recovery. You see the market falling in 2022, but then the market turns around and starts to head higher, even though we're clearly still in a profit recession. And I want to, if I can circle this, this is 5 quarters worth of falling corporate profits. That's not growth, it's contraction. So there clearly has been what they call an earnings recession in the economy. And you know, that doesn't necessarily need to lead to an economic recession, but sometimes it does. The market, the stock market, however, the blue line, turned around even before the earnings recession was over and started to march higher. And that's because stock investors are sniffing out a turn, an inflection point. And sure enough, here we are in second quarter 2023. These are the earnings announcements that we're hearing right now on the news. Still negative, but the next quarter is expected to flip and be positive. So in other words, if recovery is around the corner, it makes sense to invest ahead of that. And that's kind of what we're seeing with the stock market. One of the big reasons why the market really has had a significant rally this year. Okay, so you've seen this chart before, probably. It's really all about the landing. Can we stick the landing? In other words, can the Fed raise interest rates enough to kill inflation, but not enough to kill the economy? And the latter is usual, is typical, right? I mean, typically business cycles or economic cycles end when the Fed judges that the economy is overheated, that inflation's too high, so they need to raise interest rates, choke off credit, choke off growth, and a recession in the economy is a byproduct of sort of killing off inflation. That scenario is normal, okay? What we are looking at now is abnormal. And with all the data that we have, all the slides I've shown you today, the result is that I think there's less what they call tail risk now. That is, the two extremes on this slide are looking like they are not probable at all. So the most amazing outcome, the no landing, or the most painful outcome, hard landing, look like they're sort of off the table. And now we're left in the middle with either a soft landing or a bumpy landing. I would argue that last year was a little bumpy, but maybe that's enough. And maybe the stock market is rallying because there is not a discernibly high chance of the worst case scenario. That's what I think. You know, what happens in the future? Well, I can't tell the future, and apparently neither can Wall Street economists and analysts, because they're experiencing severe fear of missing out here. Before I read some of these headlines, Bloomberg News tracks somewhere around 25 firms on Wall Street that make forecasts, and whether that's a recession forecast, an economic growth forecast, whether it's a forecasting the S&P 500's price target at the end of this year, they track 25 of only one firm ended up predicting at the beginning of 2023 that we would have a significant rally. Just one. And even now, a huge number of shops are still saying that we're in for it. But it's getting harder and harder for them to do that. So I put together, this is just a small sampling of some of the headlines I've seen. In the middle on the left from Bloomberg, Wall Street forecasts project profit recession ends next quarter. That's what I showed you in the prior chart. If that profit recession, that earnings recession is ending, well, that pretty much explains why the market needs to move higher, right? Top left, Wall Street Journal. Economists are cutting back on their recession expectations. Fewer and fewer economists are predicting a high chance of a recession in the foreseeable future. On the top on the right, CNBC picked up what amounted to a mea culpa by both JP Morgan and Bank of America, both shops who they were forecasting probability of a recession are now saying they don't think that recession is going to come to fruition. So they sort of reverse course. B of A says they do expect a soft landing. Left-hand bottom, Fed staff, even the Fed staff economists no longer predict a recession because inflation is cooling off. And then finally on the lower right, Goldman Sachs just dropped its predicted chance of recession from 25% to 20%. I don't think that never goes below like 10. I don't think they don't dwell on 0% very much. So 20% is pretty low. In fact, I remember seeing a number of surveys from different shops at the beginning of 2023 that predicted the chance of recession was above 50%. I guess what I'm saying is it's no longer sort of a roll of the dice, 50-50, and it really does look like, so far at least, that tail risk is gone. And again, that's why you're seeing asset prices move up. So can you trust it? Yes, you can trust. In our view, you can trust it. However, I'm going to go back to something that I said at the very beginning. We cannot keep relying on the 5 or 7 top stocks in the market to drive growth. That is not going to happen. They will run out of steam. And in fact, for instance, we've seen Apple's a great company. We've seen the stock fall 9-10% from its peak recently, and that is absolutely healthy. And it would be healthy too if the entire stock market fell a little bit after the run that we've had. But you know, in order to keep this rally going, we really need to see it expand out. And a quick way of doing that is to just to monitor that is to just look at the Dow, look at other indices like value indices versus growth, and see, you know, are they coming back? We should, you know, theoretically, if we're really on the road to recovery at some point, we should see small caps and mid caps start to come back too. But they've really been losers as well, especially compared with the risk that you need to invest in them. So I guess that's my big message. This rally isn't it's not built on a house of cards. I think we can trust it, but we need to see it broaden out. So that's it for me today. I want to thank you for watching, and thank you for your trust. And we love serving you and having you as clients. Thank you so much, and we'll see you next month. Bye-bye.